Welcome, everyone. I'm excited to kick off our journey into the world of monetary policy and economics fundamentals. Today, we'll explore how the economic engine works, from the functions of money and the role of banks to how the Federal Reserve influences inflation and the broader economy. We'll also delve into key concepts like the money supply, price levels, and inflation. So, let's get started and uncover the fascinating mechanics behind our economy. Before money existed, people relied on a system called bartering. That meant trading goods directly for other goods. For example, if someone had wheat and needed clothes, they'd have to find someone who had clothes and wanted wheat. This process required a double coincidence of wants, which simply means both parties had to want what the other had at the same time. This made trade slow and quite inefficient. Then, money emerged as a universal solution. It became a commonly accepted medium of exchange, making transactions much easier. Money helps us simplify exchange because everyone agrees on its value. It also stores value over time, so you don't have to spend it immediately. And it provides a way to measure worth across different goods and services in an economy. So, in essence, money forms the foundation of commerce, enabling us to trade more efficiently and build complex economies. It's a key part of how our economic system functions and grows. Let's start by looking at the first key function, store of value. This means money allows us to save our purchasing power for future use. Unlike perishable goods, money retains its value over time, so we can save today and spend tomorrow without losing its worth. Next, we have the unit of account. Money provides a common, standardized measure of value. This makes it much easier to compare prices, wages, and debts across different transactions and over time. It creates consistency in how we evaluate economic activity. Finally, the third function is medium of exchange. Money eliminates the need for a double coincidence of wants, which is a big challenge in barter systems. Instead of finding someone who has what you want and simultaneously wants what you have, you can simply accept money as payment for any good or service. When we look at these three functions together, they highlight why money is such a crucial part of the modern economy. It allows us to save, measure, and exchange value efficiently and reliably. Let's take a moment to consider how money has evolved over time. From ancient coins made of metal to the digital wallets we use today, the form of money has constantly changed. Yet, what remains consistent is its fundamental purpose. Money's core role is to facilitate exchange, making it easier to buy and sell, and to store value so we can save for the future. This evolution highlights that while the appearance and technology behind money may shift, its power to support economic activity stays timeless. It's more than just paper or digital entries. It's a vital tool that underpins our entire financial system. Understanding this progression helps us see how innovations continue to shape our economy. But the essential functions of money remain the same, enabling us to transact and preserve wealth across generations. Now, let's explore the emerging forms of money that are transforming the way we store and transfer value. These include central bank digital currencies, or CBDCs, and cryptocurrencies. These new types of money are fundamentally changing the landscape of finance and payments. When we talk about digital currencies, it's important to understand that they derive their value from government decree and public trust. For example, the US dollar has no intrinsic value on its own. It's accepted as legal tender because the law recognizes it as such, and because people trust that it will be accepted for transactions. In contrast, fiat money, which is what most of us use daily, has intrinsic value in itself. Historically, materials like gold and silver were used because they were scarce, durable, and universally desired, so they had inherent worth beyond just government backing. Finally, there's commodity money, which is money backed by actual physical commodities. This concept has been around for centuries and includes items like gold, silver, or other valuable resources that serve as a store of value. In the modern economy, all these forms of money, whether digital, fiat, or commodity, play crucial roles in how we conduct transactions and preserve wealth. They each bring unique qualities that influence how value is stored and transferred across societies and markets. Banks are far more than just safe places to keep your money. They play an active role in our economy. They connect savers, people who want to put aside money, with borrowers who need funds for various reasons. But perhaps most importantly, banks are creators of money itself. When they lend money, they don't just transfer existing funds, they actually create new money through that lending process. This makes banks essential architects of the money supply, shaping how much money circulates in our economy. Throughout this presentation, we'll see how these roles highlight the importance of banks beyond their traditional image, emphasizing their central position in maintaining economic stability and growth. When banks lend money, they do more than just help individuals and businesses. They actually expand the overall money supply far beyond the initial deposits they receive. This is a core concept in economics because it shows how the banking system can influence the amount of money circulating in the economy. Banks create money by providing the means for seamless transactions, like checking accounts, wire transfers, debit cards, and electronic payment systems. These tools make it easy for people to pay and receive money quickly and securely. At the same time, banks serve as vital connectors. They link savers, who deposit their funds, with borrowers who need capital for things like buying a home, starting or expanding a business, or making investments. This process highlights the crucial role banks play as financial intermediaries. They facilitate the flow of funds from those who have extra money to those who need it most. This interconnected system is fundamental to a healthy economy and helps support growth and stability across various sectors. So here's an interesting aspect of how money actually works in our economy. When you deposit $1 into a bank, it doesn't just sit there untouched. Instead, banks typically lend out most of that money to borrowers. And this is where it gets fascinating. Those loans, once issued, become new deposits somewhere else in the system. This process creates a self-reinforcing cycle, where the initial deposit leads to more loans, which in turn generate even more deposits. It's like a multiplier effect that expands the overall money supply across the economy. This is why banks are often called the engine of money creation. They don't just hold money, they actively create it through their lending activities. This cycle is fundamental to understanding how our economy grows and how money flows through different channels. Throughout this presentation, we've seen how central banks and regulatory policies influence this process. But at its core, the banking system plays a crucial role in expanding the money supply through this continuous cycle. Let's take a closer look at the money multiplier formula. It's simply 1 divided by the reserve requirement ratio. For example, if the reserve requirement is 10%, then the multiplier is 10 times. This means that for every dollar of reserves banks hold, they can support up to $10 in total deposits. Now, why does this happen? Because banks are only required to keep a fraction of deposits as reserves. The rest they lend out. When they lend, those funds turn into new deposits elsewhere in the banking system, creating a chain reaction. This process is the core of fractional reserve banking. It starts when a deposit is received. The bank keeps a portion as reserves, say 10%, and lends out the remaining 90%. That loan then becomes a new deposit somewhere else, and the cycle continues. So, through this process, banks effectively create money. The money multiplier shows us how much new money can be generated from an initial deposit, based on the reserve requirement ratio. This is a fundamental concept that connects to the overall theme of how the banking system influences the money supply and economic activity. So, here we see how the process of money creation works in the banking system. Each successive loan becomes a new deposit, which then allows for another loan to be issued. This cycle keeps repeating and effectively compounds through the entire banking network. To put it into perspective, that initial $1,000 deposit can generate up to $10,000 in new money. That's the power of the money multiplier at work. Now, let's follow the cycle. $900 gets lent out from that initial deposit, and then it's deposited somewhere else in the system. This process repeats itself over and over, creating more and more money. At a 10% reserve requirement, Bank A is required to hold $100 of that deposit as reserves. That leaves $900 available to lend out again. The initial deposit of $1,000 sets everything in motion. And as these loans continue to cycle through the system, the total amount of money created can grow significantly, illustrating just how powerful the banking system is in expanding the money supply. This is what we mean when we talk about the money multiplier in action. It shows how a small initial deposit can lead to a much larger increase in the overall money supply. Founded in 1913, the Federal Reserve serves as the central bank of the United States. Its primary role is to maintain monetary stability, which is crucial for a healthy economy. Think of it as the ultimate guardian, making sure prices stay stable and the financial system remains secure. It also acts as the lender of last resort, meaning that during times of financial crisis, it can step in to provide emergency support to prevent the entire system from collapsing. This slide highlights the importance of the Federal Reserve in overseeing and stabilizing our economy, connecting directly to the broader theme of how central banks influence financial stability and growth. Let's take a closer look at the structure of the Federal Reserve System. The Federal Open Market Committee, or FOMC, is responsible for setting monetary policy. They meet 8 times a year to decide on the target federal funds rate, which influences interest rates across the economy. This is a key tool in managing economic growth and stability. Supporting the FOMC are the reserve banks, which are regional institutions serving specific geographic districts. Their role is to implement the policies decided by the FOMC and to supervise local banks within their districts, ensuring the safety and soundness of the banking system at a local level. At the top of the structure, we have the Board of Governors. This body has 7 members appointed by the President and confirmed by the Senate. They provide overall national oversight and regulation of the entire Federal Reserve System. All these components work together to form a cohesive system that influences monetary policy and maintains financial stability across the country. This structure allows for both regional insights and centralized oversight, which is crucial for effective economic management. Let's start by looking at the services the Federal Reserve provides globally. We supply financial services to depository institutions, which include banks and credit unions, as well as to the U.S. government and foreign official institutions. This means we help facilitate payments, manage accounts, and support international financial operations around the world. Next, we act as a lender of last resort. During financial crises, when banks or financial markets face severe stress, we provide emergency liquidity. This is crucial to prevent a systemic collapse. By stepping in during tough times, we help stabilize the entire financial system. Moving on to financial stability, one of our key roles is overseeing and regulating financial institutions. This oversight ensures that banks and other financial entities remain safe and sound, reducing the risk of failures that could harm the economy. Then there's bank supervision. We closely monitor banks to make sure they are operating responsibly and with adequate safeguards. This helps maintain confidence in the banking system and prevents crises. Finally, we influence the money supply and credit conditions through monetary policy. Our goal here is to promote maximum employment and keep prices stable. By adjusting interest rates and other tools, we try to support a healthy economy that benefits everyone. All these responsibilities tie together into our overall mission: to foster a stable, secure, and efficient financial system that supports the economy's growth and stability. The Federal Reserve's most powerful lever is its ability to influence the money supply and short-term interest rates. This means that the Fed can shape borrowing costs for consumers and businesses, which in turn affects investment decisions and spending. Ultimately, these actions have a significant impact on economic growth across the entire country. When the Fed adjusts these tools wisely, it can help promote stability and growth in the economy. So, understanding how supply, interest rates, and their determination work is crucial to grasping the broader dynamics of the money system and the Fed's role in managing it. This is a key part of what we're exploring in Chapter 3. Now, let's talk about how the Federal Reserve influences the banking system through its primary tool, the federal funds rate. The federal funds rate is essentially the target interest rate at which banks lend reserve balances to each other overnight. It's a crucial benchmark for overall interest rates in the economy and a key way the Fed implements its monetary policy. When the Fed wants to stimulate the economy, it might lower this rate, making borrowing cheaper for banks, which can then pass on those lower rates to consumers and businesses. Conversely, raising the rate can help cool down an overheated economy and control inflation. Next, let's look at the ways the Fed can influence this rate. One method is through adjusting the discount rate, the rate at which banks can borrow directly from the Fed. Changing this rate can make borrowing more or less attractive for banks, influencing how much they lend. Another tool is reserve requirements, the minimum fraction of deposits banks must hold and not lend out. By raising or lowering these requirements, the Fed can limit or boost the bank's lending capacity. Finally, the Fed also conducts open market operations, buying or selling government securities to adjust reserve levels in the banking system. These operations directly affect the amount of reserves banks have, which in turn influences the federal funds rate. All of these tools work together to help the Fed steer the economy by targeting that key federal funds rate, which plays a central role in the overall financial system. Let's take a look at how the expectations around interest rate cuts have shifted. Now, the market is projecting that rate cuts might not happen until December 2026. Additionally, the chances of rate hikes extending into early 2027 have risen to about 30%. This suggests that investors are now anticipating a longer period of tighter monetary policy. Moving on, one of the reasons for this delay is the recent sharp increase in energy prices. These higher energy costs have pushed our near-term inflation projections higher, making the path back down to the 2% inflation target more complicated. Essentially, higher energy prices are acting as a headwind to price stability. Furthermore, there are broader concerns weighing on the markets. Fears about disruptions caused by AI advancements, along with ongoing tensions in the Middle East, have increased market volatility. These geopolitical and technological uncertainties are influencing rate expectations, adding more complexity to the outlook. Lastly, looking back at the March 2026 FOMC minutes, they give us a real-world glimpse into the policy decisions of the Federal Reserve. They highlight how the Fed is closely monitoring economic developments to decide on future rate moves. Overall, these factors underscore the dynamic and uncertain environment we're navigating, which impacts both monetary policy and market expectations. Open market operations are the Fed's most frequently used tool for influencing the economy. These transactions are actually conducted daily by the New York Fed, and their main goal is to keep the federal funds rate close to its target level. When the Fed wants to stimulate the economy, it will buy securities, which increases reserves in the banking system. As reserves rise, banks have more money to lend, leading to an expansion of the overall money supply. This increase in available money generally causes interest rates to fall, making borrowing cheaper and encouraging spending and investment. So, through open market operations, the Fed effectively controls the money supply and helps steer the economy toward its desired goals. It's a key mechanism that links the Fed's policy decisions to real economic outcomes. Let's talk about price levels and inflation, and how they are really the consequences of money itself. As we move through this chapter, you'll see how the value of money impacts not just prices but the entire economy. When there's too much money circulating, prices tend to rise, which is what we call inflation. This isn't just about small price increases. It can significantly affect purchasing power and economic stability. Throughout this chapter, we'll explore how different factors influence price levels and why understanding the role of money is crucial to grasping broader economic concepts. So, as we connect these ideas, keep in mind that money isn't just a neutral medium of exchange. Its behavior shapes the entire economic landscape. So let's talk about how inflation is actually measured. Essentially, economists track the prices of a representative basket of goods and services over time using standardized price indexes. This basket includes items that typical consumers buy regularly, giving us a good sense of how prices are changing overall. When inflation goes up, it means that each dollar we have now buys less than it did before. In other words, the real value of our savings, wages, and fixed incomes decreases because prices are rising but our income isn't necessarily keeping pace. Inflation isn't about just one product getting more expensive. It's a broad, sustained increase in the overall price level in the economy. This means that the purchasing power of money erodes across the board, affecting many different sectors and types of goods and services. Understanding inflation helps us see how it impacts our everyday financial decisions and the overall health of the economy. It's a key concept that ties into everything else we're discussing today. Let's talk about the measures that look at the prices received by domestic producers for their output. These are important because they can often serve as a leading indicator, meaning changes in producer prices can give us clues about future consumer inflation. One key index here is the Producer Price Index, or PPI. It tracks the prices of a fixed basket of goods and services that producers sell. You'll often hear about PPI in the media, especially because it can signal upcoming changes in consumer prices. It's also used for practical purposes, like adjusting Social Security benefits and tax brackets. Next, we have the Consumer Price Index, or CPI. This is the Fed's preferred measure of inflation. It's designed to reflect what consumers are actually paying for goods and services, and importantly, it adapts over time to changes in consumer spending patterns. That flexibility makes it a comprehensive way to gauge overall price changes in the economy. Finally, there's the PCE Price Index, which also measures inflation, but with a slightly different approach. It's particularly favored by the Federal Reserve because it provides a broad view of inflation, capturing shifts in consumer behavior and spending habits. In summary, these indexes, PPI, CPI, and PCE, are all vital tools for measuring inflation. They help policymakers, businesses, and consumers understand how prices are changing and plan accordingly. They each serve a unique purpose, but together give us a well-rounded picture of inflation trends. Now, let's talk about why stable prices are so important for the economy. When prices are stable, it creates the right conditions for the labor market to reach its full potential. In other words, it helps ensure that employment levels are as high as they can be without unnecessary volatility. Having a small, positive inflation rate, around 2%, actually prevents a dangerous spiral where falling prices could stall growth. If prices were to fall persistently, consumers and businesses might delay spending and investment, which would slow down the economy. Low and predictable inflation also acts as a buffer against deflation, giving households and businesses the confidence to plan for the future. When inflation is predictable, everyone can make better financial decisions, which supports steady growth. This brings us to the concept of price stability. A common target for inflation is about 2%. Why 2%? Well, it's a carefully chosen balance, high enough to avoid deflation, but low enough to keep prices stable and predictable. To clarify, the Federal Reserve's explicit goal is to achieve this average inflation rate over time, as measured by the PCE Price Index. This long-run target of 2% helps anchor expectations and guides our policies. In summary, maintaining this 2% inflation target helps us foster maximum employment, prevent deflation, and promote a stable economic environment, really the foundation for a healthy and resilient economy. Let's take a closer look at how specific economic events have historically impacted inflation. In the period from 1974 to 1981, We saw that an oil embargo combined with a loose monetary policy led to stagflation. That means we had high inflation alongside slow economic growth, which is a tough situation for policymakers to manage. Going further back, between 1942 and 1948, the aftermath of World War II caused dramatic swings in prices. The reconversion from wartime to peacetime economies created a lot of instability, leading to these sharp price fluctuations. Even earlier, during 1917 to 1920, inflation surged during and after World War I. This was driven by soaring government spending and shortages of goods, which pushed prices up rapidly. Looking at a broader view, over a century of U.S. inflation data from 1914 to 1997, a clear pattern emerges. Wars and supply shocks tend to be the main triggers for major price spikes. This pattern highlights how external shocks and government policies can significantly influence inflation over time. Understanding these historical trends helps us see how similar forces might impact the economy today. Let's take a closer look at recent inflation trends. Consumer price inflation has eased quite a bit from its peak in 2022, which is encouraging. However, the challenge now is the last mile, that is, getting inflation all the way back to our 2% target. This is often the most difficult part because it requires fine-tuning policy to ensure inflation stays stable in the long run. The Federal Open Market Committee, or FOMC, remains committed to this goal. They are focused on returning inflation to that 2% level over the longer term, even if the recent data shows some progress. Now, when we talk about inflation measures, the Fed looks at the core PCE, which excludes food and energy prices because those can be quite volatile. This measure gives us a more stable view of underlying inflationary pressures. As of the latest data, the core PCE is at 2.8% for the 12 months ending in January 2024. While this is an improvement, it's still above the 2% target, indicating there's work to do. Similarly, the overall PCE inflation stands at 2.4% as of March 2024. This shows some easing, but it's clear that inflation remains above the target, which keeps policymakers focused on balancing growth and price stability. In summary, recent inflation data shows progress, but achieving that last mile back to 2% remains a key policy challenge for the Fed. The goal is to keep inflation anchored at this level, supporting a stable and healthy economy over the long run. So, why does printing money lead to rising prices? Well, the answer is rooted in one of the most fundamental principles of economics. It all comes down to the relationship between the amount of money in circulation and the prices we see every day. When there's more money floating around, but the same amount of goods and services, it tends to push prices up. This concept is central to understanding inflation, which we'll explore further as we look at how changes in the money supply directly impact inflation. So, the key idea here is that increasing the money supply without a corresponding increase in goods and services can cause prices to rise. This is a crucial link in the overall story of how monetary policy influences the economy. All right, let's take a closer look at this core insight. If V, which is the velocity of money, and Y, the real output or the quantity of goods and services produced, stay relatively stable, then any increase in M, the money supply, will lead directly to an increase in P, which is the overall price level. In other words, more money chasing the same amount of goods tends to push prices up, resulting in inflation. Now, let's clarify the key variables here. Y represents the real output. Think of it as the actual goods and services produced in the economy. P is the average price level, so how much, on average, prices have risen or fallen. V is the velocity of money, or how quickly money changes hands in transactions. And M is simply the total amount of money circulating in the economy. This relationship is captured perfectly by the equation. M times V equals P times Y. We call this the equation of exchange, which forms the foundation of the quantity theory of money. The main takeaway is that if V and Y are stable, any change in M will directly influence P, and that's a core principle in understanding how inflation can occur, especially when the money supply increases without a corresponding increase in goods and services. This concept ties back into the overall theme of how monetary factors impact the economy. Conversely, when the money supply decreases, it reduces the spending power of consumers and businesses. This means there's less money available to buy goods and services, which dampens overall demand. As demand drops, prices tend to go down as well, potentially leading to disinflation, where inflation slows down, or in more severe cases, deflation, where prices actually fall. Now, on the flip side, when the money supply grows faster than the real output of the economy, more money is chasing the same amount of goods. This increased demand for goods and services pushes prices upward, which is the classic mechanism behind inflation. So, in essence, changes in the money supply directly influence inflation, either by cooling down the economy when money is pulled out or heating it up when money is poured in. This connection is fundamental to understanding how monetary policy impacts overall price levels. The FOMC is strongly committed to returning inflation to its 2% objective. Every policy decision we make is based on a careful assessment of incoming economic data, the evolving outlook, and the balance of upside and downside risks. It's a constant process of weighing these factors to ensure we're making the best decisions possible. Our goal is to balance the dual mandate of maximum employment and stable prices, which are both essential for a healthy economy. So, when we adjust policies, it's always with these priorities in mind, aiming to support sustainable growth while keeping inflation in check. This ongoing commitment demonstrates how serious we are about maintaining price stability, which underpins the overall economic stability and confidence. When both goals are in alignment, low unemployment and stable prices, the economy is said to be at its long-run equilibrium. This means that everything is balanced and the economy is operating at its optimal point over time. The Fed's two mandates, though, can sometimes pull in opposite directions. For example, tightening policy to control inflation can slow down hiring and increase unemployment. On the other hand, easing policy to boost employment can sometimes lead to higher inflation. Navigating this tension, that delicate balancing act, is really the art of central banking. It requires careful judgment and a nuanced approach to keep the economy stable and growing. So, in essence, the Fed must constantly weigh these two priorities, understanding that their actions can impact both employment and prices in different ways. That's why managing these mandates is such a complex but crucial part of their role. Now, let's take a closer look at some of the housing-related assets the Fed has acquired to support credit markets during times of crisis. One key example is agency mortgage-backed securities, which are essentially pools of home loans that the government guarantees to help keep the mortgage market functioning smoothly. During the pandemic, the Fed bought U.S. government bonds as part of stimulus programs to inject liquidity and stabilize the economy. These purchases included Treasury securities, which are debt instruments issued by the U.S. government to finance its operations. However, as the economy has evolved, the Fed's approach has shifted. Instead of adding assets, it's now engaging in what's called quantitative tightening, or QT, where it actively reduces its holdings. This process withdraws liquidity from the financial system, which helps reinforce the Fed's stance on fighting inflation. After several years of large-scale asset purchases, what we call quantitative easing, the Fed has now moved toward shrinking its balance sheet to prevent the economy from overheating. So, to sum up, the Fed's recent actions reflect a transition from providing support through asset purchases to tightening policy by reducing those holdings, all with the goal of maintaining financial stability and controlling inflation. Let's take a moment to review some key concepts at a glance. First, the quantity theory of money suggests that when output and velocity are stable, the growth of the money supply is directly linked to inflation. In other words, if the amount of money increases and other factors stay constant, prices tend to go up. Moving on, the Federal Reserve manages the money supply primarily through tools like open market operations, reserve requirements, and the discount rate. These are the levers the Fed uses to influence how much money is circulating in the economy. Next, we have fractional reserve banking, which is a system that allows banks to create more money through successive lending. When banks hold only a fraction of deposits as reserves, they can lend out the rest, leading to a multiplied increase in the overall money supply. Finally, money serves three main functions: as a medium of exchange, a unit of account, and a store of value. These functions are fundamental because they underpin virtually all economic activity. Connecting all these points, understanding how money is created, managed, and functions helps us grasp the broader picture of monetary policy and economic stability. Now, let's look at how changes in the money supply impact the overall economy, particularly the price level and inflation, through the lens of the quantity theory of money. This theory helps us understand the relationship between the amount of money in circulation and the prices we see in the economy. Essentially, when the money supply grows faster than economic output, it tends to lead to higher prices, what we call inflation. Conversely, if the money supply shrinks or grows more slowly, inflation may slow down or even turn into deflation. This connection is crucial for policymakers because it shows how controlling the money supply can influence inflation and overall economic stability. Understanding this relationship allows us to evaluate inflation dynamics more effectively and to see how monetary policy can be used to maintain a healthy economy. And with that, we come to the end of our module. Understanding money, banking, and inflation isn't just an academic exercise. It's essential for making informed decisions. Whether you're a household, a business owner, or a policymaker, knowing how these forces interact helps you navigate the economic landscape more effectively. The Federal Reserve plays a crucial role here. It works to manage these forces to promote a stable, growing, and prosperous economy for all Americans. Remember, these concepts are interconnected, and grasping them empowers you to make better choices and understand the broader economic environment we all live in. Thank you for engaging with this material.